planning at the tax year end in relation to capital gains is potentially more feasible than year-end planning for income tax, simply because you could make a disposal at the year end and generate that gain or loss that you're seeking to generate more easily than trying to whip up or generate some income at the year end to make sure it's taxed on a person with a lower tax rate, because it's very difficult when you don't have control over that income. Of course, that is possible if you control the income source, namely run your own business. So capital gains tax planning, a little more easy in theory. In practice, of course, it's not that relevant on the face of it to that many people. Only just over 250,000 people pay capital gains tax in the UK. So only 250,000 people pay capital gains tax, but that might well not be the case in the future. And there are a lot of people who will have the potential to pay capital gains tax. And so ensuring that they maximise the use in particular of their annual CGT exemption as they go along their investment pathway can pay off really, really well in the future. So let's have a look at the context for capital gains tax planning. It's one of relative stability, because the government have recently stated that in response to the Office of Tax Simplification's pretty radical suggestions for reform, they're not taking any of those forward, any of those more radical suggestions like taxing capital as income or getting rid of certain exemptions and allowances. So basically, we've got pretty much the same system that we've been working with for many years leading up till now. And that will probably remain the case at least until the next election. So that's the context, one of relative stability. So what should we be looking at when we're thinking about our planning? Number one, making sure that we use our annual CGT exemption if we can. Number two, if we're in a relationship, the couples, each of them should be able to use their CGT exemption. Don't forget children and grandchildren, they also have CGT exemptions to use, the annual 12,300 exemption. Also, of course, remember that once you've exceeded the annual exemption, the capital gains rate is determined by reference to your level of income. So if capital gains flow to someone who has a fair bit of basic rate threshold left, then the CGT rate is going to be 10% instead of 20%. That's a definite benefit, of course. So making sure that the gains flow as far as possible, and all other things being equal, and there's no particular challenge to transferring capital to someone to ensure that they have a lower tax rate. Then make sure that the gains flow into an area where the tax rate is lower or the exemption is available, and ideally both. Now, if you're going to transfer capital to someone else in your family to ensure that they can use their annual CGT exemption, or to ensure that the gain that arises over and above an available annual exemption is taxed at a lower tax rate, then it's important to take account of the CGT implications of the transfer itself. Transfers between spouses and civil partners are CGT neutral, and the person receiving the asset inherits effectively the base value of the individual who's transferred it. And of course, if the transfer is of cash, then CGT isn't relevant, sterling that is. Transfers to other than spouses or civil partners, of course, it's different. It's deemed to be that transfer, a transfer or a disposal at market value. And so a capital gains tax liability could arise. That may be something that you want to happen because you've got an unused CGT exemption. Just keep in mind that when making capital transfers to other than the spouse or a civil partner of an asset that is subject to capital gains tax, so not cash sterling, then that may itself give rise to a CGT consequence. It might also be relevant for inheritance tax, so you need to take that into account too. So having made the transfers and got your assets owned by the right people at the right time, then what should we be considering? Using the annual CGT exemption, as I mentioned earlier in this video, is really important to do, even though you think, well, I'm not thinking of disposing of this asset itself, actually disposing of it and getting the money from it at this point. But we're making a disposal whereby the gain that arises by virtue of disposal is tax-free within your CGT exemption. What you will be doing is raising the base value of that investment for a future disposal. So when you eventually dispose of it into the market, then you will be making a gain of a much lower amount because the base value will have been raised by virtue of the disposal that you made earlier within the CGT exemption. But of course, you won't have the asset unless you reacquire it. So reacquiring the asset is essential if you want to keep it for that future disposal in a tax efficient way. How do you do that? Well, you just buy it back, and you make the disposal, make the gain's within the exemption, and then you buy back the asset, typically say an investment in the market. Yeah, there are commercial costs to doing that, but also you'll need to consider the tax implications of that, because there's some anti-avoidance provisions well known for many years called the bed and breakfast provisions, whereby if you buy back the same asset, share of the same class, for example, within 30 days of selling it, then the whole transaction is effectively ignored and you don't secure the advantage that you were seeking. So how do you get around those bed and breakfast provisions legitimately? By buying back something else is the most obvious thing. Yeah, but I want to buy back the same asset, you say, because I'm really just doing this to raise the value up so that I have a higher base value when I eventually sell it. I want to actually keep the asset though. But no, I can't use my CGT exemption unless I actually sell it. How do I get it back? Well, if I get it back within 30 days, I don't want to be out of the market for that long. I'm going to trigger the bed and breakfast provisions, the anti-avoidance provisions. So how else can I do it? Buy back something else that is very, very similar in the same sector of the market. Because if it's not an identical share class, then a share of the same class, then you won't have that challenge. Or buy it back in another place, have something else buy it back, your pension fund, if that's possible, your ISA, if that's possible, or possibly have your spouse buy the asset back. And it's the same in relation to triggering losses, ensuring that you make the disposal in the, I'll deal with losses a bit later on. I mentioned earlier that children have their own CGT exemption, and yes, they do. And that's the case even if the asset that they dispose of, giving rise to the gain, was an asset that was given to them by their parents. So that anti-avoidance provision that's relevant for income tax doesn't apply for capital gains tax. As I mentioned earlier, the CGT rate that's applicable to a gain that exceeds the annual exemption is effectively a function of how much of the gain falls within the basic rate band left after taking account of your income, and how much falls into the higher additional rates of tax. And it's 10% for the basic rate, 20% for the higher rate. Remember, of course, that if it's a disposal of a residential property that isn't your main residence, or it's carried interest in private equity, then the rates of tax are 18% for basic rate and 28% for disposal of residential property. And remember, the new rules for disposing of residential property, you'll need to make a return and a payment of tax within 60 days of the disposal of that residential property and the gain arising on it. Not relevant, of course, for your main residence, which remains, thankfully, completely exempt from CGT. Don't forget also that making a pension contribution can effectively generate CGT savings in relation to any gains that you make, because that pension contribution, depending on whether it's made net or gross, will either expand the basic rate threshold for net contributions or reduce taxable income for gross contributions, which will leave more headroom, as it were, for a capital gain to fall within the basic rate than if the pension contribution wasn't made. So a useful addition. More will be said on that on our pension contributions tax year end video. There's also a year end bit of thinking to be given in relation to losses. Remember, if you make a capital loss, any losses made in the tax year will be set against gains in that year. So you have no real control over that. If you make a loss in a year, the gains will be set, the loss will be set against the gains, even if that loss takes your gains below the annual exemption, so you could end up kind of losing some of your annual exemption. That's not the case for carried forward losses. Carried forward losses, you have the choice as to whether you use them or not. And if you've got some annual exemption left, to the extent you have it left, then you wouldn't use a carried forward loss because you'd be wasting it. You just carry it forward to the next tax year. And before leaving year-end capital gains tax planning, don't forget the opportunities to potentially defer a capital gain that you have made in the tax year by making a contribution to an enterprise investment scheme. I'll be dealing with this in more detail when I look at tax efficient investments and year-end planning.